Hello, welcome to Money Gist Top 5. I'm Olayemi Cardoso. Governor of the Central Bank of Nigeria, Olayemi Cardoso, says the CBN is now working with the Securities and Exchange Commission to design a sustainable framework for digital currencies in the country. Speaking at the Lagos Business School on Friday during the maiden edition of the CBN Governor Lecture Series, which also commemorates the second anniversary of his leadership at the Apex Bank, Cardoso admitted that crypto, fintech and blockchain will play a role in currency policy, but the full impact is still uncertain. He recalled how Nigeria shot into global crypto prominence just 2 years ago, becoming one of the world's largest trading hubs. Regulators struggled, exchanges multiplied, and everyday Nigerians turned to digital coins. Now, the CBN and SEC are collaborating to bring proper oversight and structure to that fast-growing space. Cardoso also revealed that the central bank has gone digital internally. Approvals are now fully electronic with AI tools in play and a goal of running a paperless office. He urged future leaders to protect their credibility, stay focused despite challenges, and communicate clearly, especially on complex policies.
Now we already have a couple of initiatives that are going round on this, and we put some experts together to look at that space, digital currencies. We're doing that, but it's early times yet. But as I say, I do believe that there's certainly a role to play somewhere.
And on the economy, Cardoso insists reforms are restoring investor confidence, with global capital starting to take a fresh look at Nigeria. The Central Bank of Nigeria is making a major move in the financial markets. Beginning this November, the Apex Bank will start a phased takeover of the Nigerian fixed income market, with the aim of making the system more transparent, more efficient, and better aligned with Nigeria's economic growth agenda. In a formal statement signed by Oke Umeano, Acting Director of the Financial Markets Department, the CBN revealed that it will now assume direct control of both the trading platform and the entire settlement process for fixed income transactions. This matters because fixed income instruments such as government bonds and treasury bills are vital for managing monetary policy and attracting investment. By tightening its oversight, the CBN hopes to strengthen market integrity, streamline operations, and create a unified regulatory framework that ensures full visibility over how transactions are carried out. The transition will not happen overnight. It begins in mid-October with user acceptance testing of the new settlement system. After that, a pilot phase will run side by side with the existing platform to make sure the system is stable. By the 3rd of November, the settlement process will fully migrate to the new CBN-managed platform. Then, on the 1st of December, the CBN will activate the new trading environment for primary dealers, market makers, pension fund administrators, and other authorized participants. The bank says this phased approach, carried out in collaboration with the Financial Market Dealers Association, will help ensure a smooth rollout with minimal disruption. At the heart of it all is the CBN's push to deliver a more transparent, more resilient, and more efficient fixed income market, one that can truly support Nigeria's monetary policy and overall economic stability. Let's talk about the Naira. It's been on a winning streak lately. The Naira extended its rally last week, closing around 1,465 Naira to the dollar at the official market and about 1,460 Naira at the parallel market. That narrow gap between both markets signals growing confidence and reduced speculative pressure. Analysts say this renewed strength comes from strong foreign exchange inflows, mainly from offshore investors and international money transfer operators, along with steady central bank interventions that kept the market stable. Interestingly, the Naira held firm even as global oil prices fell, suggesting the currency is becoming less dependent on oil trends. Still, the dip in oil prices following OPEC's plan to increase production could put some pressure on Nigeria's earnings if it continues. Despite that risk, analysts expect the Naira to remain largely stable in the coming days, helped by sustained dollar inflows and a softer US dollar. And here's another positive sign. Nigeria's external reserves have been on a 12-week climb, now standing at about $42.4 billion, giving the central bank more room to support the currency. The takeaway is clear. The Naira's recent momentum looks solid, but the global oil market remains one factor to watch closely. Talking about oil, Nigeria's oil and gas sector is bouncing back in a big way. The Upstream Petroleum Commission says active rigs have jumped from just 8 in 2021 to 69 this year, a clear sign of renewed investor confidence. The Commission credits this rebound to clear policies under the Petroleum Industry Act and the federal push that Nigeria is open for business. One key move is the drill or drop rule. Companies that don't explore their fields must give them up. That's already freed hundreds of dormant oil blocks and spurred fresh activity. NUPRC has also approved billion-dollar asset sales from Ajib to Oando, Shell to Renaissance Energy and others, part of a broader shift to deepen offshore development. On gas, the flare-out program is attracting new investments and cutting emissions. The Commission says host communities have received over 350 billion naira, funding schools, health centers and road projects across all producing areas. Oil theft is also down sharply by about 90% thanks to tighter surveillance and joint operations. And in a major reform, new digital licensing rounds have replaced the old manual system, earning praise for transparency and global best practice. It drives home the message that Nigeria's upstream sector is regaining its strength with cleaner operations, stronger rules, and real benefits for local communities. Nigeria's pension industry is gearing up for a major shakeup. The National Pension Commission (PENCOM) has raised the minimum capital requirements for pension fund administrators (PFAs), tying them directly to the size of each firm's asset under management. In simple terms, the bigger the pension fund, the more capital it now needs to hold. Under the new rules, PFAs managing less than 500 billion naira in assets must have at least 20 billion naira in capital. But once a fund crosses that threshold, it must also add 1% of whatever it holds above that mark. The 7 largest players, including Stanbic IBTC Pensions, Access ARM, Leadway Pensure, NPF Pensions, Premium Pensions, Trust Fund Pensions, and FCMB Pensions will all need to inject billions in fresh capital before the December 2026 deadline. PENCOM says the new framework is designed to strengthen the financial health of the pension system, improve service delivery, and ensure long-term stability after more than 2 decades of the contributory pension scheme. But not everyone is convinced. Some analysts argue that the higher thresholds seem excessive, especially for PFAs that don't take the same level of balance sheet risk as banks. Others warn that the move could trigger a new wave of mergers and acquisitions as smaller firms struggle to meet the target. Still, PENCOM insists it's all part of a broader plan to keep Nigeria's pension industry strong, resilient, and ready for future growth. So, will this recapitalization drive make the pension sector more resilient, or will it squeeze out smaller firms? We'll be watching closely. Don't forget to drop your comment on any of the stories in the comment section below. Like, share, and subscribe for more insightful updates. It's been Money's Top 5, and I'm Olayemi Cardoso. See you in the next video.